Ever wonder what the historical rate of return on housing is? How does that compare to other investments? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about housing compared to other assets overall, housing compared to other assets decade by decade, and how calculating housing rate of return can be a bit more complicated than other assets.
Yeah.
I'm going to bring your attention to these like and subscribe buttons down below there. Go ahead and click on those if you want to catch future episodes of The Vault with Doug, Garrett, and myself. And let's go ahead and get started on things here. Garrett, you want to start this off with a disclaimer about what exactly about real estate we're talking about here.
Yeah, absolutely, Brice. So what we're trying to capture in this episode is this topic on your rate of return on housing does not apply to those who are in the business of flipping homes, those who are in the business of being large landlords and basically getting a rental income stream off of the properties. What we're trying to capture is what is the historical or real rate of return on housing for your average American family who has one primary home, and how does that compare to other investment categories over time.
So this is kind of like for the buy and hold real estate owner.
Yeah, just most people have one primary home. That's all they're really interested in. And so how is that wealth of that home growing over time compared to other assets?
Fair enough.
Okay?
All right, so let's get started. Housing compared to other assets overall.
Absolutely. And before we get into that, Brice, I do want to give a shout out to some sources we used for this episode. Okay. We borrowed some historical data that we'll get into here from Dr. Aswath Damaradan. He's from Stern Business School at NYU. And then also Ben Carlson, CFA. He has a blog called Wealth of Common Sense, where a lot of this data is also represented. So link to the sources below. That being said, Brice, let's look at how housing compares to other assets overall from a long historical standpoint. And I'd like to bring up our first graphic here. So if we look at this comes from Professor Damaradan, and he has done the calculation of valuation all the way back to 1928 to present day 2023, last complete year that we've got, and we can see the list here. Stocks over that long period of time have averaged about 9.8% rate of return. If you go in the bond market, you're about 4.6% rate of return. By the way, this is a 10-year bond that he's using as the benchmark. Cash, we're talking about cash that's in a high yield savings account or a CD, about 3.3%. We see real estate coming in here at 4.2%, gold at 4.9%, and then inflation over that entire period of time, 1928 to 2023, inflation at about 3%. So very interesting when we look at it just from an overall long historical view. We find that real estate really comes in about the middle of the pack. I want to jump now into the next point that you brought up, which is
housing compared to other assets decade by decade.
Decade by decade, yeah. So let's bring up graphic number 2, because I think this really will capture a lot of experience that people have lived through over the course of their lifetime. And this is a great graphic.
Yeah, it's really helpful to see it in a graph like this.
Yeah, and shout out to Ben Carlson for doing this. Wealth of Common Sense, if you want to check out that blog. But what he's done here is he took Dr. Damaradan's work and he broke it down even further by decade and said, okay, if I was an investor in the stock market, let's say in the 1990s, well, the stock market, if I go down there on my first column, that grew by 18% over the entire 1990s, compared to real estate, which is 4 columns over, about 2.7% there. Now, one thing that I noticed looking at this data, which is very interesting, is that if you look at the overall stock market, it's had multiple decades of double-digit returns. If we go all the way over to the 4th column, real estate, we find that real estate has really only had one decade that's experienced double-digit returns, and that is the current decade that we're living in.
That we're not even
completely through with.
Yeah, not even halfway through yet.
Exactly. So the thing that I find interesting is if we're talking about real estate, value, a lot of people, we hear the buzz out there, real estate, prices are going up and up and up. Is that really some recency bias that's creeping into our overall perception of what is a realistic expectation of the real estate market.
It happens.
It does happen. It happens to the best of us, right?
Yes.
And so that's why we need to go back to the numbers and the data to kind of give us a sanity check. So that's a little bit interesting. You can see here how gold has performed, how bonds have performed, and most assets have had at least 2 decades of double-digit returns.
Right.
The only one that compares to real estate, which with only a single decade of double-digit returns, would be bonds. But you can see how just this decade-by-decade analysis is a great tool for us to just kind of have a sanity check of how the different asset classes perform over time. Now, here's another interesting piece, Brice, and I want to get to that third question that you proposed to me, and how do we calculate, a real estate?
Why is it? It's more complicated than calculating real returns on other investments.
Exactly. So let's, and I want to spend some time here, folks, because this is something that we really have to understand. It's not simply a matter of I bought a house for X and then I, lived in it for 10 years and I sold it for Y and that's my rate of return. So let's do a breakdown of how we calculate rates of return for most other assets and how housing is wildly different.
Even if you didn't live in it, even if it wasn't your primary residence, does this still apply?
Oh,
what you're about to talk to.
It absolutely does. So to understand that, let's go back to just more traditional investments such as stocks, bonds, even cash and gold.
Right.
Calculating that rate of return is pretty straightforward.
Yes.
You have the beginning price that you bought it at, then you basically add up any cash flows you got along the way, whether that's interest spitting off from a CD or perhaps a dividend from a stock that you own. You add all that up, and then you basically have your sell price, and that is, over that period of time, your real rate of return when you back out inflation, okay? Now, admittedly, none of that calculation that I explained for stocks, bonds, cash, and gold takes into account any fees you may have paid or taxes. But that being said, fees these days, getting into the market, the frictions you may experience, meaning the fees that you're paying for ETFs, even mutual funds, are relatively low. And getting into the market, the friction to actually get into that market isn't that big of a deal anymore. Housing
Not like it used to be, right?
Not like it used to be. Housing is very unique from all these different assets in that for most people, there's a high level of friction to get into the investment and then even to maintain the investment. So let me break down what I'm talking about here.
Ownership costs.
Ownership costs. For a majority of investors, there are some people who buy houses just straight out in cash. They pay all of it themselves, cash up front. That is not the case for a majority of people. Most people are going to finance the largest purchase of their life. So there's a leverage component.
Yes, there
okay.
is.
So let's use an example. Let's say you put 20% down on a house that you found and it was priced at $450,000.
Okay.
And then over the course of a couple of years, that rises to 25%, and now your home is worth $562,500. So what's your real rate of return here? Is it 25%? Or is it perhaps 125%? Well, let's break down the math here. The price of the actual home went up $112,500, okay? But your initial investment was only $90,000, right? That's your 20% down on a $450,000 home. Well, that's a return of 125% on your initial investment.
Gotcha, I'm with you.
Or so it may seem. Let's talk about the cost of owning a home that most people don't factor in. Okay, if you're like most people and you had to finance the purchase of that home, you're paying an interest expense.
Right.
You're paying an insurance expense for homeowners insurance. Of course, there's property taxes all along the way. And when have we ever seen property taxes go down? You don't.
I don't recall that they ever have.
Right. You're lucky if they stay the same. There's also a maintenance and upkeep aspect to your home. You got to clean your gutters.
Yeah.
You probably have to reseal that deck outside. Most people, or not most people, but a lot of people, when they get into a home, they want to do some renovation.
That's right.
Okay.
You're throwing some money in right off the top.
Or at least the first couple of years, finding that contractor that you like, redesigning the home the way you like, that all costs money. Then let's say you got into a mortgage that you don't particularly like and you want to refinance to a lower mortgage in the future. Well, that costs money too. Yeah.
Right. So this is, you don't have stock owners insurance.
No.
You don't have to seal your stock portfolio.
No.
You don't have to reseal the stock portfolio for your stock portfolio.
No, you don't.
Yeah. You don't have to insure your stock portfolio.
Absolutely.
Okay.
And it keeps going from there. There's moving costs to get inside of a home.
Ah, it's true.
There's closing costs that you pay the realtor. There's inspection costs just to make sure that the home that you're buying is up to code. There's title insurance and other financing fees that the banks put on you. So there's a lot of costs that people don't necessarily consider. A lot of people just skip to the end there. They say, oh, I bought the home for $450 and I sold it for $562. That's my rate of return. No, you didn't really understand your cost structure of owning the home.
Basically as simple as net returns versus gross returns.
That's right.
You could sum it up like that.
That's right. Exactly. So we're not saying this, guys, to basically say that housing is a poor investment, but we are saying that it is a very unique investment in the fact that there's another component to housing that is really difficult to put a valuation on, and that is it is the most emotional investment that anyone has. Everyone creates memories of kids growing up, family gatherings, you name it, that all occurs at the home that you know and love, that is difficult to put a value on, but you're sentimental to it. And
it becomes part of your identity to a certain sense.
Yes, and it means so much to you. But when you actually look at all the numbers based, we find that real estate investing is middle of the pack. Middle of the pack.
Okay.
The other piece that we have to consider is that let's say that you did sell your home at a pretty high premium and you got a nice capital gain. Well, you have to live somewhere. Most people are going to have to take that money that they just got from the sale of their home and go live in a different home that has also appreciated in value. Unless you're willing to downsize significantly, it's unlikely that you're going to be able to enjoy a lot of the gain that you just received off of your primary home.
That's right.
So, again, folks, we hope that this data really helped you guys understand what the true cost to owning a home might be and how it's not as clear-cut as you might think.
Very good. All right, well, that's going to wrap it up for this episode of The Vault. Hope it was informative for you. Again, feel free to hit these like and subscribe buttons down below if you want to catch future episodes with Doug, Garrett, and myself. I do want to remind you, financial plans do not create themselves. I'm Brice.
And this is Garrett.
And this has been The Vault.